investors ask, is now a good time to buy? But the more experienced ones ask a different question. How do I structure this property so it actually works long term? And that's exactly what we're going to be breaking down today, using SMSF as a strategy of building wealth through property. So good evening, everyone, and welcome to today's educational session hosted by Premium Select Finance. My name is Ravi, and I'll be your host for today. Before we get into it, just to set some expectations, this is a broker-led educational session designed specifically for property investors. And most importantly, this is focused on structure, not sales. Today is about helping you understand how SMSF works in the real world so you can make informed decisions, not rushed ones. Just a couple of quick housekeeping items. This session is being recorded for those who may want to revisit it. Please keep yourselves on mute throughout the presentation. If you have any questions, feel free to drop them in the chat. We'll cover them during the Q&A in the end. We'll also answer some of the most common questions we usually get, so you'll still get value even if you're not unsure of what to ask. Before we continue, a quick but important note. Everything we discuss today is general information only and does not constitute financial or tax advice. SMSF is not suitable for everyone, and we strongly recommend speaking with a licensed financial advisor and tax professional before making any decisions. At Premium Select Finance, we always work alongside your adversary team. This should never be a standalone decision. So what are we really talking about today? We're diving into building wealth through SMSF property. We'll break it down into 5 different groups: how SMSF actually works, what lenders look for, the rules you need to understand, real life scenarios, and what works and what doesn't, and most importantly, how to assess if the strategy actually fits your situation. Because the goal here isn't to push you into SMSF, it's to help you decide properly. And to walk us through all of this, I'd like to introduce our speaker for today, Karthik Sharma. Karthik works closely with investors on structuring complex lending scenarios, particularly around SMSF and strategic property acquisition. What sets him apart is his ability to break down technical structures into something practical, realistic, and actually usable for investors. He'll be taking you through everything step by step today. So Karthik, over to you.
Thank you, Ravi. That was a very nice introduction. Appreciate that one. All right, guys. Welcome to our next session or second session, or actually, I think third session, sorry, of our PSF opportunity. And today, what we'll be talking about and what we'll be going through is how to build wealth through SMSF properties or self-managed super funds. And this is just a new way in light of the current situation, the current worldly situation, what's happening with the market and how things are moving. This is just another avenue to open up your minds and get you thinking about certain things, to find other avenues as investors so that when we do go through times like this, we aren't just held in place and feel like we're not moving anywhere. At least this gives another avenue. So, main question for today is why investors are exploring SMSF. And the reason that investors are exploring SMSF is that SMSF gives greater control over retirement strategies. So with the SMSF, a lot of people they believe that working all your life and earning your super is the only way to increase your super, or it may be in a situation where you are doing some sort of salary sacrifice or making certain decisions about industry supers. Um, this SMSF allows full total control and lets you choose how you wish your funds to be used. When you're working with industry super funds, they usually only work allowing them to make the decisions for you and make the investments for you, whereas self-managed super fund, either be it properties, stocks, and any other avenue that you can build wealth in your super, um, that will allow it. SMSF will allow it. Dissatisfaction with traditional super performance. I think some people will definitely know about this one, but a couple of years ago, there was a time when everyone's industry super funds were decreased by about 10%, or I think it was a loss of 10,000, something like that. Whereas everyone's very used to an increase of their super every year. So at least with an SMSF, like with the point before, your full total control allows you to do your own research without having to rely on someone you've never even met before to control your super. Um, Familiarity with property as an asset class. People who are already investors on the residential slash personal side. They already know how things work, what areas work, what's good, what isn't good. And SMSF allows them to make the exact same decisions that they do within their personal lives as well. So that gives them, again, complete and total control over their super as well. Um, it's a long-term wealth structuring tool, and also it's separate from regular lending. A lot of people may not realize that SMSF is actually separate from your personal lending. So you may have one or two or three properties in your own personal name, but SMSF lending is completely separate because they use ABN structures and things like that. So because of that reason, um, it does not, even though you may be tapped out in this section of your life, you may have three, four properties already, or maybe even two, and you feel like you're tapped out and you can't invest more, but you want to invest more, SMSF will allow you to continue doing that, and build that wealth for yourself. What is an SMSF? Most people would be asking that as well. They may have heard the word fly around, but never really understood what it is. SMSF is self-managed super funds, essentially just like your industry super, but completely and totally controlled by you as the director of the SMSF. Um, and SMSF can hold up to about six members, sometimes even more, plus beneficiaries, and those sort of structures. And yeah, directors, trustees, all those guys, whatever the structure may be, um, are totally responsible for the decisions and the compliance, along with your tax agent. If they are in control of that, most of the times they are due to annual reviews and things like that. So with those people combined, complete and total control, decisions and compliance is totally on you. Um, so yeah, just with that comment there, with control comes responsibility. That's the trade-off. Obviously, with an industry super fund, it's just sort of kick back, kick back, relax. Whereas with an industry, with a SMSF, it's a bit more, you have to keep on top of these type of documents and compliance and things like that. Um, SMSF versus traditional super. Key differences: control high versus limited, investment choice broad and restricted, and responsibility trustee versus fund provider, which we had mentioned, or I had mentioned in the last slide. Obviously, control, it's completely yours, whereas an industry super, it's very limited. They don't let you do anything. Investment choice, self-managed super fund allows you to invest in a broad range of things, either be it stocks, property, whatever it may be. Whereas with an industry super, it's only in the stocks that um, they wish to look into. Responsibility, trustee versus fund provider. Obviously, trustee being the person themselves with the SMSF, full responsibility on them. Whereas fund provider, whatever they say goes, and that's how you have to proceed with that one. Um, is SMSF suitable? Um, so SMSF is a suitable choice for most people. Some people it may not be. Um, Either be it not enough in their super, or they don't have the right structures, or they may be in a position where the foreseeable future is not in the right frame for them to own an SMSF. So long-term investment mindset, SMSF is something that you hold for a very, very long time. It's not something that you look to sell, purchase and sell, purchase and flip, which you may do with your regular investments. SMSF is something that you hold till retirement or through retirement. So, um, sufficient balance, commonly 200K as a guide. So we would say that anything between 160 combined, it can be a combined super between yourself and your partner, or if you are solo, depends on the situation. But um, I would say 160 to about 200 is a very good range. And if you have way more than that, that's perfect. You may even want to get two, whatever it may be. Willingness to manage or outsource administration. Um, that's just fairly simple, that one. Um, Next, can SMSF buy properties? Yes, they can, but very restrict regulatory requirements, and they must meet the sole purpose test, which is the retirement benefit. Um, SMSF is very highly regulated, lots of documents required, lots of the right structure needs to be in place. Um, and A lot of the banks, when they do this sort of loan or provide this loan, they do have a couple of things, couple of requirements other than the government regulations. They also have their own things like stress tests, just to make sure that for whatever reason, if you are investing, you're not putting yourself in a position where you'll be worse off by investing your super. Putting 100% of your super, some banks they require at least 10% or 20% to be held within the super and allow you to um, invest in before they allow you to invest. SMSF property rules. This is a big one. I think a lot of people don't actually realize. So one, you cannot live in the property that you purchase through SMSF. Under no circumstance can you live within the property. Um, Cannot rent residential property to related parties, so it has to be completely separate. Can't be any sort of family member or anything. Has to be outside of that. Must be arm's length transactions, so there can't be private sales. You can't go to a family member and ask them to sell you their house and purchase it under an SMSF, and you must follow SMSF lending structures, which is a fairly simple one. But usually, if you speak to your trusted advisors, they would be able to inform you what those lending structures are, which includes property trusts and family trusts and whatever that may be. Um, how SMSF lending works, SMSF trust structure. They have a bunch of different structures. It's all a bit very silly, but it works, and that's what the governments and the banks want to see. So you would have an SMSF trust structure. You would have a bare trust arrangement as well. Um, and due to the regulations of SMSF, it is a very rare um, product within the lenders. Um, most lenders do have them, but a lot of the major lenders, like your big fours and things, they used to offer it a lot less strict, under less strict pretenses before. But now they require a lot of requirements before you're actually able to get an SMSF with them. But there are lenders out there, even if it's your first SMSF, they've got no issue whatsoever. And typically higher deposit requirements, that is a big one as well. A lot of people, they usually work off 80%, or at least a 20% deposit, inclusive of stamp duty, and other fees. But with SMSF, we could be looking at, 75% to 70%, is something lenders are more comfortable with as well. Potential benefits, greater control. Mentioned that a couple of times now. Long-term growth potential. If you are to hold this property for some time, say you've bought the property in your 40s and you retire at 75 or 80, let's say, um, that's 40 years worth of growth within that property, which with a 30-year loan term, your loan should be paid off, which could also let you access um, post-retirement income through that property as well. Um, Tax advantages within the superannuation rules. I think this is a big one. Obviously, we aren't tax agents, so we don't know the full codes, but there is quite a big benefit, especially after retirement, owning these properties, um, either wanting to sell or keeping them with you as well. Quite a few tax advantages as well. But obviously, speak to your trusted advisor, speak to your tax agents, accountants, before making any sort of decision on that. Risks and considerations, liquidity risk. So like I mentioned before, the banks would like to see some of your super to remain in the super. They won't allow you to put 100% in. So that's a big one. Concentration risk, ongoing costs and administration. So things like the annual review with your accountants, sometimes that can cost quite a bit as well. Um, and keeping the ABNs open and things like that. Obviously, most times it's paying for itself, but there are situations where the amount of expenses aren't covered to the required amount. Compliance obligations, that's also a big one, something that is quite heavily regulated with the government. They like to see everything is on point, no risks involved and no security issues as well. So that's a big one, I think, as well. SMSF scenarios. Let's have a look at this one. Investor couple, mid-30s, 280,000 in combined super between the two of them. Stable dual income, both working, both earning their respective super. Um, Purchased an investment property via SMSF. Um, key Key insight, works when supported by consistent income and buffers. So as long as you're consistently working and earning that super, that obligated super um, from your employment, you're in a quite a good position depending on what your income is, or at least the super income. So one main thing about SMSF is that the banks only work the serviceability based on your super contributions, not your actual payslip and what you're earning throughout the year or your salary. Super contributions is the only thing that the banks really look at. And that can also include salary sacrifice as well. If that's something that you are doing, that can be included in that as well. Um, so in that key insight, works when supported by consistent income and buffers. So, if they may have um, regular super contributions and a salary sacrifice, that also puts them in a good position. Business owner strategies. So this is for more of the I guess, the commercial side of it, for people that are business owners. Business owner with growing cash flow, SMSF purchases a commercial property. The business leases the property. Um, and with that, the key insight is that the business owner is able to redirect the rent that the business is paying to the SMSF or whatever is um, the SMSF that holds the commercial property. They're able to redirect those funds back into their super, and use that towards their retirement savings as well, which I think is a very good strategy for business owners. Instead of leasing out a property for someone else's gain, you're able to at least purchase a property in the commercial space, and lease it out so that you may, um, I guess, take back. It's not really reaping the benefit, but taking back what is rightfully yours in terms of the money that you're earning through your business. Okay, so over leveraged investor, I think this is the main reason that I like SMSF. So the investor has a high existing debt, so they may have three, four properties at this time, and they have very limited liquidity. The outcome is the cash flow pressure and the reduced flexibility. So, because they are tapped out, I guess is the way that we could explain it. In one space, um, they're uh, they're able to actually access, other opportunities through the SMSF as well. Late starter strategy. This is a decent one. This is one that I've seen quite heavily, I would say, in my personal experience. People with the over the age of 50, they have a very strong super balance. Uh, they Although they are in that age where a lot of people start to slow down when it comes to the investing side, um, the super allows them to at least keep that going for their retirement benefit, especially with, a lot of people that are retiring around that 70, 75 mark. So a lot of people do get to reap the benefit, of, knowing that in at least 20 years that they would be able to have a property that may have minimal debt, but at least they have some income that's a constant cash flow on top of whatever they may have already invested on their personal side as well. So, owning four properties, two in the personal and two in the SMSF, is a lot better than owning just two properties in the personal side at the end of by the time that you retire. Commercial SMSF, SMSF plus company lease back, scenario one. Um, so the company, this is essentially just like what we spoke about before. This is very similar to the property or the business paying rent back to themselves, and at least keeping that hard-earned money that was there. So own a business via the company, SMSF balance approximately 500,000. Purchase a $1 million commercial property, which is then held in the bare trust. Company leases from the SMSF, so company will work in that property. And then the rent that is paid, say it's 34,000 or 40,000, whatever it may be, is then paid back into the super instead of being paid into someone else's pocket. So key points is market rent plus formal lease. Um, SMSF must service the loan, which is obviously a big one, for the banks to even consider your situation. There needs to be a clear separation between the company and the um, SMSF in this situation, so they can't share the same ABNs or whatever it may be. Um, and obviously, there's a bit of a tax benefit in there as well. There's a lot of tax benefit when it comes to SMSF. So, um, SMSF plus family trust. So businesses under the family trust. SMSF balance is around 650,000. Purchasing a property for 1.2, which is held in the Bear Trust. Trust leases from the SMSF. Rent builds super. So same thing. This is just another way, depending on whatever your situation may be, if you have a separate structure for your business. This is also another way that this structure also works as well. So the good thing about SMSF is that it is also quite diverse in terms of the structures that can be used. Obviously, no personal name under personal names, but it is quite diverse as well, allowing you to sort of play around with whatever structures work best for you. Common mistakes. What investors often get wrong, treating the SMSF like personal investing. So people that purchase to flip or sell. This is SMSF is not a short-term plan whatsoever. And I think that's where some people seem to get it wrong. I have had situations where people have questioned why they would hold the property for so long. Underestimating the costs for it, proceeding without a professional team. So obviously, like we mentioned before, speaking to your financial planner or tax agents or accountants. Um, those are the guys that would be more versed in this, as obviously mortgage brokers, we are fairly versed in the loans, but when it comes to tax codes and things like that, that's definitely not our forte. And what's a way to combat that? Obviously, a structured approach, engage with a financial planner, consult a tax professional, and work with an SMSF experienced broker as well. How does a broker support you? A broker will support you by looking through your borrowing capacity, um, helping you create the right structure. Obviously, we don't create the structure, but it's just based on how it's set up in the sense of that the loan is under the SMSF and it may go to the family trust or Bear Trust, whatever it may be. Collaborate with your advisory team, provide clarity on feasibility. Obviously, if it's something that we think wouldn't be in your best interest, that's something that we would let you know. But at the end of the day, it is your decision. Um, but and getting a second lens on the situation. Most investors don't need more information, they need clarity on whether this structure actually fits their position. And we offer a focused SMSF structure assessment as well. So that's essentially what brokers can do. And if this is something that interests you, feel free to request an SMSF structure assessment. And this is not something that is pushing you to do it, but this is something just to open up your minds and see if it's something that works for you. But obviously, like we said, speak to your trusted advisors before proceeding. Question and answer. This is where I may get um, Ravi and Aaron to help me out a bit here. But thank you guys. Thanks for listening to me ramble on about SMSF. I hope it was helpful. I hope it brought shed some light on the situation and gave you a bit more to think about. Allowing you to make those informed decisions and build your wealth. And at the end of the day, all we want is to be comfortable in our lives. So if this is something that you think could make you more comfortable, then I'm happy that we were able to help you get there. But disclaimer, obviously, this is not advice, and please speak to your trusted people, speak to your trusted advisory team before making any sort of decision when it comes to the SMSF side. So I'll move on to the question and answer. I'll pass it back over to Ravi.
Before we do that, Karthik, I just wanted to say thank you for that breakdown. That was pretty informative. I know there was a lot to take in that session there. So before we proceed with the question and answers, I wanted to backtrack a bit with the SMSF commercial, and I wanted to get some of Aaron's input, as we did recently complete a SMSF commercial scenario, and it was pretty informative. So I just want to hear some thoughts and some things of note that you could potentially add to inform people about commercial SMSF scenarios, Aaron.
Thanks, guys. Thanks, Karthik. That was really informative. Um, when we talk about commercial SMSF, it's really quite targeted to self-employed people as well. So, say for example, if you've got your own business and you're renting out of somewhere, you can potentially redirect all your rental money back into SMSF just by acquiring a property in SMSF under commercial. So that's the biggest takeaway for the self-employed people out of commercial SMSF. Um, Essentially, if you have ever thought about doing anything with SMSF, commercial or residential, reach out. I mean, we can help structure, we can give you an assessment on it. You'll have you'll know how much to borrow, you'll know how much the cost is, you'll realize that it's not as complicated as people make it, um, and how different it is to industrial supers compared to your self-managed super fund. Um, Initially, when people think about SMSF, it's a scary thought because we're changing directions from what's always been told us, government to put everything in self-managed super, and then we're changing direction to doing it ourselves. So um, it's mindset, um, but we can help with just assessment, and there's no cost to it. So yeah, um,
Okay. So there's something of note for self-employed individuals that are looking to expand on the SMSF portfolio
yeah,
is most lenders do prefer 2 years financials. So if that is something that is unavailable to you, you may find yourself having limited lending options in terms of providers. Another thing of note is if, for instance, in servicing, your super contributions from your employer isn't enough to cover the serviceability of the loan structure. I think we can look into is what's known as below the line servicing in our industry, and how that essentially works to kind of give you an idea is we account your finances on your personal side, and we combine it to figure out if there is any surplus available. And if there is any surplus available with the loan scenario we're currently working on and whatever's in your personal name, we can input that into the calculator to improve your serviceability. And how it will work is if, for instance, there is a repayment that was unable to be made with the super contributions, we can tap into that surplus to cover those repayments for those amount of for that period in time. There are restrictions to how much surplus we can include in servicing, and if you'd like to learn more about that, feel free to reach out. Regarding what we're going to be talking about next, I know there's a lot to take in that session right there, so I want to sum it up with three key takeaways from today's session so far. In short, SMSF is not about buying properties, it is about structuring your retirement strategy properly. Number two, just because you can do it doesn't mean you should. Suitability depends heavily on your position, your super balanced income, and long-term plan. And number three, the biggest mistakes happen when people move forward without the right structure and the right team around them. That's where most of the risk comes from. So let's get back into the Q&A, Karthik. Let's see what we got.
Okay. Think I'll take the help of Aaron and you on this one.
That's fine.
So yeah, so to keep this Q&A appropriate for everyone, questions requiring personal financial details will be addressed at the general level. We'll suggest a private follow-up where individuals' circumstances are involved. Um, I think I'll ask Aaron on this one. From your experience, what are the key indicators that tell you an SMSF structure actually fits someone's situation, not just that they qualify for it?
key indicators that tell. I think most important is the age of the person. if you're returning to retirement, you've only got 5 or 6 years left in your term before you retire, it might not be suitable for you. Um, Generally, banks are looking at 15 to 20-year loan terms, so that always is a question in there. Um, Other factors that contribute is how much super you got. If you've got around 200,000 combined with your partner, and depending on what your income is, then if you can satisfy a loan, how big the loan is, will also depend on the key factors of how you're going to structure it. Now, in terms of structure, do you want to structure it as in a discretionary trust, or do you want to do it in a super trust? It's entirely up to you. Depends on your income, depends on how much super you contribute, and depends on how much you're happy to work with accountants and financial planners, and how much time and effort you want to put into your super fund and your self-managed super fund as well. Just by looking at how much balance you have doesn't necessarily mean that you do qualify for every loan. It also looks at what income's coming in, what contributions you're making, and what type of trade you're in as well. So yeah.
And just like on the residential side, the location of the security does matter and it can impact servicing and acceptance of the lender allowing you to take on that security. Um, let's say that the security is not in the most ideal location. Sometimes lenders can input a LVR restriction, which then would require a larger deposit from your super to complete the transaction. And that could potentially mess up serviceability, and it's something to just keep a note of.
Yep, sounds good. Thanks for that, guys. Move on to the next one. Um, so maybe I'll get both of you guys to answer this one as well, and maybe I'll jump in here and there. What do lenders look at differently when assessing an SMSF loan compared to a standard investment loan? And where do most applications fall short? Maybe Aaron, I'll get you to start off on this one.
This is Ravi's is all over this one, assessment side of things. Yeah, Ravi.
Yeah, I mean, because this is what like an entity structure, so living expenses isn't really something that is accounted for in SMSF serviceability. Another thing of note is what replaces that is we have to account for SMSF fees and all that stuff. We also have to make sure that we have to make sure at the end of the day the super is self-sustaining. So if that is not the case, then that's how the loan does fall short.
Yeah.
Quite often we don't realize that SMSF may have some costing to it. So when you do a standard assessment, your valuations and stuff might come from free. Usually, sometimes in SMSF, you'll have to pay for your valuations, which could end up being up to $1,000 for residential, and if it is commercial, it could be up to $3,000 as well. You got to input extra cost in terms of your having a solicitor, and you need a second solicitor. Or you also need an accountant and a financial planner. So all these professionals do come up with the cost. So you have to incorporate $5,000 or $6,000 costing for all the professionals. Um, Bank application fees, as Ravi said, do come into place as well. Um,
As well as the liquidity test. Not all lenders action it the same way. Some
yeah,
lenders have different ways of how they assess a liquidity and stress test. Usually it's 5% of the super and 5% of the loan amount. And
yeah.
if the balance can handle all of that, um, then the deal can work. But these are some of the factors that make SMSF loan structures different and to a residential investment property purchase loan structure.
Yeah, perfect. Thanks, guys. Move on to the next one. For someone considering SMSF property, what are the risks that aren't obvious at the start but tend to show up later? Maybe Aaron, this is something that's best for you, I think.
Risk these days, well, the biggest risk is if you buy an SMSF property and decide to pack up and move overseas, that might not work for you.
Mm.
So ideally, if you start the SMSF property, they'd want you to stick around to the term of the loan. So the risk involved is it is a long-term thing. It's not just it cannot you can't just do things quickly in SMSF. Uh, at the start, the risk is your employment. Is it stable? Are you going to be there? Quite often, if you're jumping employment from one to the other, it becomes hard to contribute. So they look at your contributions, and then you might need to make sure the contributions are coming from you, just in case you're out of employment. So obviously, start. If you get your structure wrong down the track, if you buy a second or third in super, it might become a bit difficult. So you've got to make sure you get your trust structure right from the beginning. Um, who you start a trust structure with, you can have up to 6 people, but usually it's a couple, and it's a set if somebody else from outside comes in, could become a risk down the track.
And it's also very important to be able to seek an independent legal and financial advice just to make settlements process more smoother. So just bear in mind that that is something that the lenders will ask for settlement. The bank solicitor, let me amplify that. So just bear that in mind, just so that you aren't shocked when you realize that there are some things that we need from you at settlement.
And there's always the cost involved that if you're not ready to pay the cost for valuations, the solicitors and accountants, and quite often this may come out from super, but if your super doesn't have enough deposit, you will have to fork that out from your pocket. So just be prepared for extra hidden costs. Although when we do an assessment, we account for these and usually
Mm.
inform what the cost may be.
Yeah, yeah,
And
that's a good answer.
what we did forget is the cost of finding a property. You may need some help finding property for SMSF as well. But yeah.
Yeah, that's
Yeah,
also
that's
true.
true.
Um, all right, if someone is on the fence right now, what would you say are the non-negotiables they should have in place before even considering SMSF? Aaron, maybe.
I think
But the question is,
I think we're going. It's a similar answers to everything.
Mm,
Stability and income, deposit you have, the type of property, the postcode of properties. It's just these are with the amount of money you got in your super will kind of decide where what you kind of limited to where. And if you've only got 150, that's probably bare minimum. If you've got a little bit more, you've got a bit more flexibility. Um,
and you can't just like one day decide, you know what, I'm gonna get a SMSF loan, and there you go, I'm gonna get it. You're gonna need to talk to a lot of professionals. You're gonna make sure, you have to make sure that
yeah, and you,
advisors have said the structure can be suitable for you before
yeah,
you even consider it.
I mean, even though it's a trust structure and you say that you're not liable, it's the trust owns it. If the bank gives you a loan, you're still signing a guarantor that if you don't make payment, they'll come after you. So,
Mm.
um, yeah, the guarantor documents. Yes, the trust owns it. Everything goes to trust, and it's not affecting your personal liabilities. Um, yeah, if you miss payments, and then you will. Bank always wins.
yeah. Well, I think that is our last question, I believe. So yeah, just wanted to say thank you for the people that have joined us, and for the people that may be listening. We appreciate your support and your time with us here. I know that the team also appreciates it as well. But we want to thank you for being here, and we hope to see you on the next PSF webinar.